Gautam Duggad, who joins in from Motilal Oswal Securities, Head of Research, with us on the show. Gautam, good morning. Great to have you with us on board. Let's talk about that, big bank consolidation, the big PSU merger that was announced. Dena, Vijaya and BOB will merge to form the country's third largest lender. Take us through how you're reading into this move. Is it something that was pretty much inevitable and on the cards?
Yeah, hi, good morning. It actually came as a surprise because people had stopped talking about this part of the equation for a long time now. But it gels in well with what the government has been doing for reforming the banking system. Whether you look at the RBI mandated AQR or PSU bank recap, then the RBI circular of February 10, IBC code. I think this is just another step on that front, but it's a very big bank step. It's unprecedented, 3 banks merging. And what government has also kept in mind is that they've not merged 2 weak banks. They've taken one anchor bank, one good PSU bank and another stressed PSU bank. So as far as numbers are concerned, when you do the arithmetic, it's not changing the key parameters meaningfully. Of course, from the next 12 months point of view, there will be usual integration related bottlenecks which will be there, whether it is people integration or cultural integration. But from a back-end perspective also, if you see, all the 3 banks are using the same core software, so that eases a bit. What is more important is that the government has taken this decisions 9 months before the election, so that clearly signals the intention of the government. And I think post-elections, and if this merger plays out well, and if the government comes back after the election, I think we will have few more mergers on the card. Remains to be seen how the merger ratio, swap ratio pans out. So stock prices will of course react to that. But from a long-term perspective, it's clearly a very good decision in my view.
Good morning, and that really has been the big contemplation, besides of course raising the swap ratio, which is why I guess you're seeing the pressure play out on BOB as opposed to Indian and Dena Bank. But what else could be in the pipeline? Because if you look at the stronger list of the banks, there's only one India bank. The rest of them are relatively weaker when it comes to their book quality. Who do you think is next on the big consolidation list?
Aisha, I think we are done at the moment as far as this consolidation is concerned. The next merger, if and when it is announced, will of course be after election, because this itself will consume a lot of time. There is 4 to 6 months which will be taken only for approval related formalities, and after that how it pans out, how the employee related and labor union related issues are sorted out, that will provide a good template for government to contemplate the next steps. I don't think in the near term you're going to see any more announcement as far as PSU bank merger is concerned. Obviously SBI they had done last year, which is the largest. It's obviously out of the list for any other merger. But I think as far as this particular part of the banking reform is concerned, for the moment we will not see much. A lot of time will be consumed in executing this merger itself, and then depending on how it plays out, possibly after a 9-month, 12-month period, we will have to see, depending on how the NCLT cases progress, how the asset quality equation shapes out for most of the stressed PSU banks. Then perhaps a fresh look can be taken at that.
How have you read into, all of the measures that have been taken with respect to curbing the currency volatility? It seems like it to some extent fell short of street expectations. It's not like you saw any sort of recovery in the currency yesterday. Do you believe that, the government's defense wasn't really enough to swim against the kind of risk aversion tide that is swarming us?
I think it was a step in the right direction. I don't think any big bang step was necessitated, because currency was overvalued for a long time, and that has corrected to an extent. Fact remains that even in CY18, despite all the problems in the world, despite all the problems on the macro front, India still remains a very resilient economy, and in a way it's reflected also in the large cap indices, the way they have behaved. The performance of Indian market has been the best amongst the emerging market pack. So we are amongst the better performing markets. We have far better fundamentals, whether you compare today with other markets or whether you compare it with India itself way back in 2013. growth is higher, inflation is lower, and most of the other macroeconomic parameters are far better, whether it's twin deficits or forex reserves. So I don't think any big bang step was necessitated. Whatever 4 or 5 steps they have announced, whether it is with respect to the hedging on manufacturing firms or ECB or even masala bonds, I think it's a small step in the right direction. It's not going to change anything materially in the near term. The implications, one will have to see how it pans out in the medium term, but I'm not really too concerned on the way the currency has played out so far. I mean, it was necessitated. You speak to most of the corporates who are exposed to the exports, they've been complaining for last 2 years as far as the currency was concerned. We were too overvalued. So that has that overvaluation has been taken out now. What is more important and what is required is stability on the policy front rather than any knee-jerk reactions to manage the currency.
Fair point. What else do you do right now, Gautam, in the market? I mean, is this decline to be bought on an overall basis? What are your sectoral or stock preferences and across market cap categories, that is?
Sure. So I think as far as the market is concerned, there are two things which have happened. By the sheer fact that we've been the best performing market, it also means that our premium with respect to other emerging markets have gone up to more than 60%, whereas the average versus MSCI emerging market has always been around 40-45%. So valuation wise, there is a very little room left for Nifty because we are now trading very close to 20-21 times 1 year forward. And at the same time, we have seen bond yields have shot up to 8.1%. So clearly the gap between bond and earnings yield is not providing any rosy picture as far as further valuation uplift is concerned. So the rise at all, if at all, from here will have to be led by surprise on the earnings front rather than P multiple expanding. I will be very happy if we manage to close around this 11,000, 11,500 mark on 31st March 19 also, because then what that would mean is that we will be trading at somewhere around 17.5 times FY20 EPS. By then the EPS projection would have been rolled over to FY20. That will be far more palatable from a price to earnings multiple point of view, from a valuations viewpoint. Right now the risk reward given where valuations are is not looking too comfortable. Sectorally, we've not had much of a change except for the fact that in the last 3-4 months we've been advocating changing underweight positions on pharma. So we continue to like the private financial space. We continue to like the consumption theme. Consumption stocks have corrected in the last 2 weeks by anywhere between 8 to 10%. We like autos. We like selectively IT. IT has also run up. So it's not a broad-based preference for IT, but selectively we still like IT given where currency is right now. And as I said in the beginning, pharma is a sector where we think the underweight positions, if somebody is having a material underweight, that needs to be corrected. What we don't like sectorally is the industrials and the capex part of the place. We don't like telecom as yet. So not much change as far as the sectoral concentration is concerned for our model portfolio.
Gautam, but by and large, you believe that if at all we are going to see a leg up, it's going to be contingent or largely going to hinge on the fact that we'll see earnings recovery. So that thesis still remains, correct? What are, the sectors that you believe will drive this earning recovery growth?
So clearly, if you see the projections on Nifty, where we are today, we are projecting around 20% earnings growth for Nifty in FY19. And if you look at Nifty excluding those 3 corporate banks which have introduced an element of volatility in the Nifty earnings over the last 3-4 years, excluding those 3 banks, for the rest of the 47 Nifty companies, our projection is of around 16-17% earnings growth. Where we see strong bounce back in earnings recovery this year is obviously because of the very depressed base. The corporate banks are expected to post a strong performance in second half. We think consumption will do very well. We continue to believe that autos volume growth has been solid, and whatever margin pressures are emerging, it will be manageable. Private financials continue to lead the earnings recovery, while metals have been a very strong have seen a very strong outperformance on earnings front in the last 2 years. The fact remains that there's not much representation for metals in the Nifty space. So again, you go back to the same old sectors, and IT, of course. IT has reported a 14-15 quarter high earnings growth last quarter. So IT has seen a big move up as far as the salience in Nifty is concerned. IT is now around 13.5-14% of the index versus 10% a year and a half back. So IT, consumer, private financials, select commodities, and the corporate banks bouncing back. Those are the sectors where we think the earnings recovery will be driven by the sectors.
That's largely a large cap tilt and flavor. But what about the mid caps? And as a cluster or as a segment, would you say, Gautam, that they would fall less in the current wave of the dip in the market, because for them the fall had already preceded what the large caps were doing, and ever since the start of February, or for that matter January end, the correction has already played out?
Despite the correction that we have seen in the last 6 months in mid caps, the premium of mid cap index to large cap is still at around 25-30%, which is a very chunky premium, and it has got accentuated over the last 2 years. The recent correction, of course, has seen a narrowing of that premium from somewhere around 50-55% in December to now around 25%, but it is still very expensive compared to large cap. So as a pack, we still prefer large cap to mid cap. And secondly, the flows also determine which way the mid caps will move, and we have seen significant moderation in domestic flows in the last 3-4 months. We were clocking an average inflows of around 10,000-12,000 crores 4-5 months back. That has come down to around 7,500 odd crores as far as domestic inflows are concerned. Obviously, simultaneously we have seen a moderation in FII selling in the last 2 months, but put together the total flow which is coming into the market has moderated, and that has a significant implication on mid caps. So I will be very cautious on mid cap even now, given where valuations are stacked up from a top down perspective. Of course, in mid caps you always have meaningful bottoms up opportunities across sectors. That will continue to be there, but from a broad picture viewpoint, our preference still stays with large caps, given the elevated premium at which the mid caps are still trading despite the recent correction.
Gautam, let you go on that note. Many thanks for joining in and giving us your assessment of the markets, where you believe there is potential and the sectors that you're completely steering clear from. So the general view is that it's earnings recovery that is going to drive the markets, the macros, and consumption recovery, though that will continue to remain key.